Welcome back in, ladies and gentlemen. So we're going to talk about two underperforming healthcare companies here that I personally have been keeping an eye on. Most of you know I'm pretty bullish on Pfizer under $27. It's at the top of our watch list, and it's starting to reapproach those levels over the last year a bit. Definitely been an underperformer, down 6.6%. We take a look at CVS. This is down 23% over the last year, has multiple headwinds. So we're going to dive into these two companies because healthcare as a sector has been an underperformer, and these two names specifically have been underperforming the sector. So double underperformance for both of these names, but two names that I've been following. We're going to talk about why I'm more neutral on CVS. And so let's start with CVS. Now, CVS has been dealing with a tremendous amount of headwinds. They're dealing with healthcare costs growing, which is impacting margins, and they're also dealing with an underperformance of their pharmacy fronts. So now we have a CEO stepping down, being replaced by the PBM exec, David Joyner. The big reason why I'm now neutral on the stock is for the last year, I've been very bullish on CVS. It's always seemed cheap, but unfortunately, they haven't been able to execute. And a big part of that has been lack of management. And so one of the big factors we look at when we're investing is when companies are making massive acquisitions and they might be paying overprice for these acquisitions, you have to have very strong management and innovation in place to execute at a very high level. And that's been where CVS has been lagging. And that's where I personally have missed the mark, putting faith in Karen Lynch to really turn things around for CVS. Now, I think a lot of it has to do with unfortunate events of healthcare costs skyrocketing on CVS. And we've seen that with a lot of the health insurers as well. It's not just a CVS problem. It's kind of a problem across the board. When we look at a valuation, for me personally, I think anything under $55 a share could make sense for CVS. Even at this point in time, as you guys can see here, basically between $48 to $55 is an ideal range where, I would be possibly looking to enter. At this point in time, it's a neutral stock for me. Not really interested unless it goes extremely cheap here. But let's dive into CVS here and let me know down in the comments if you own CVS or if you own Pfizer. Would like to know what your thoughts are on both of these companies. So a few things happened in their last earnings report. Obviously, we see Karen is out. We have a new CEO in. Maybe that'll refresh some things here. But what I want to start out with is just kind of their recent quarterly report. They are taking guidance off the table, which is scaring investors. So we could see here, headwind after headwind after headwind. But at some point in time, is this going to be a bottom in the stock? At some point in time, can they really turn this ship around? And what I want to show you guys is just how cheap this stock really is. And just because it's cheap doesn't necessarily mean it's a buy. So first thing I do want to point out is premiums are definitely growing for their Aetna side of their business here, going from $49 billion to now over $61 billion. We see a little bit of underperformance in storefronts. They're going to be closing a lot of storefronts, which is hopefully going to grow margins. But because of all these uncertainties, I kind of need a quarterly report to make sure margins are growing. That is the prime problem for me personally with a company like CVS. This is a company that does over $300 billion annually in revenue and has less than 1% margins, and that's what the problem is with this company. So even with the underperformance of storefronts, we still see total revenues heading in the upward direction, which is phenomenal to see when we're looking at these large of numbers. The healthcare costs, guys. Take a look at the incline in healthcare costs over the last 6 months, going from $42 billion in healthcare costs to $55.6 billion in healthcare costs. We take it down to a quarterly basis, going from $21.7 billion in healthcare costs to nearly $28 billion a year later in the same quarter. So this is where the red flags are coming. They can't control this right here. This is uncontrollable healthcare costs. And so that is the big red flag that I've been seeing. And to be quite honest with you, I kind of feel bad for Karen being fired because unfortunately, this is something that you can't really control. It's a big problem here, and it's actually scary when you're talking about these large of numbers and how fast the cost side is growing. It really limits the opportunity for margin growth on this company, and that's where I think a lot of investors are possibly throwing in the towel. But we can see here, CVS is on pace to do over $360 billion in top-line revenue, which is phenomenal. Not many companies are doing over $350 billion of top-line revenue. But then we look at the valuation of CVS here. It's under a $70 billion market cap. We compare that to maybe like a Cigna. Cigna's sitting at an $86 billion market cap, nearly $87 billion market cap. We take it down to the financial side, and they're not even doing nearly close the type of revenue that a company like CVS is doing. So for me, it's all about the margin. It's all about integrating all the acquisitions that this company has made. CVS has spent a tremendous amount of money on acquisitions and really haven't been able to show investors that they're growing the business and growing margins. And so that's where the problem lies with this company. And it's even uglier when we bring it down to a net income basis here. The company's doing $5.5 billion more in revenue, but the net income is nearly cut in half. And so this is where the red flags are starting to come for CVS. So when we bring it down to an EPS standpoint, 6 months ended of last year, they did $3.15. And now they're doing $2.29. When we bring it down to a quarterly basis, they're doing $1.41 versus $1.48 last year. And what do we always talk about on this channel? Stock price is going to follow EPS. The nice thing is they are returning capital to the shareholders in two ways. Not only do they buy back stock, they do pay a nice dividend. So when we look at total debt sitting at nearly $80 billion, now it did get as high as $85 billion, and we've seen that they've been able to kind of manage this debt, but when we look at that from an EBITDA standpoint, let's say they have $80 billion in debt, we minus out that $12.5 billion in cash, we get $67.5 billion in total debt here, and then we divide that by the EBITDA of what we're projecting out. And we're going to project out on the low end right around 14.5 EBITDA, and that gives us a 4.65 debt to EBITDA ratio here, which to me is just on the cusp. We like it to stay below 5. Ideally, you like it around 3 and below. But for this company and for all the acquisitions that it's been making and for all the headaches that it personally has, I think it's in an interesting area where it's still manageable. I would like to see that debt actually come down. And so maybe we do see a dividend reduction. We start seeing debt being paid off and getting that to a healthier standpoint. As I've stated, I was lucky enough to get in around $56, get out around $56, and now it's at $54. I think I would get re-interested in the stock if it did get into the 40s somehow. When we took a look at a Schwab rating, they think this could be an outperformer, giving it a B rating. Morningstar believes it can be an outperformer as well with a narrow moat. And most other companies have it as a hold, but we're going to click on Morningstar and get an idea where stock price should be for the company. Now, they did this analysis when the stock was at 63, nearly $64 a share. They believe fair value is sitting around $93. Most recent estimates have been downgrading the company because of the recent earnings report, which is now going to lead us to Pfizer. This one's actually pretty interesting for multiple reasons. When we take a historical snapshot of the stock, we can see that it does have its ups and downs, and it's trading at historically low valuations here. And with that historically low valuation, we have over a 6% dividend yield. So something to consider as well for dividend investors. So I want to just briefly talk through Pfizer very, very quick here. This is going to be a quick review on Pfizer just because I've done so many videos. I'm sure people are tired of hearing about them. I want to talk about how they smashed earnings here. They grew top line revenue by 31%, and this is attributed to a lot of their COVID products, Paxlovid being the highlight of that. The other problem is, or the other reason why the stock is now muted, is the majority of their earnings are over. They blew the doors off of earnings for third quarter, and they're guiding for fairly muted fourth quarter earnings. So the return is not there for a lot of investors. So two negatives, I would say, and it's not really negatives, I actually look at this as opportunities, is number one, one of their best selling products was a COVID product. The market doesn't like that because that's not sustainable. They don't believe that's sustainable, and it's just nothing you can really rely on. I technically look at this as still money. It's still printing free cash flow. It's still allowing them to pay down their debt. It's still allowing them to possibly make more acquisitions down the road. So for me, I actually like the fact that they blew the doors off of earnings, and having such strong earnings is bridging the gap for their stage 3 items that could be coming in the next quarter. Overall, I think it's fairly neutral. I think it's a great earnings. I understand why the market's discounting it, but at the same time here, we got to look at what they've done over the last few months. Over the last 9 months, the company is earning $2.48 versus $1.73. And the crazy thing about this is the stock's basically trading in the same range as it was when it was earning $1.73. So I look at that and I say, well, it still looks pretty cheap to me, and it still looks like the fundamentals are actually getting stronger. And we've talked about them possibly kitchen sinking their last quarter. The revenue still totaled $13.6 billion, which is an increase of $1.7 billion or 14%. So if we take out the COVID remedies, we're still seeing operational growth within the company. What's the other thing we really saw them do that they talked about doing is the cost savings plans. When we look at the cost of sales going from 9.2 billion down to 5.2 billion, down 43%, those expenses are coming down, which is essentially growing those margins, and they don't need to do as much revenue to create as much free cash flow as they did prior. So they're starting to get more efficient. We're starting to see some organic growth. So this is why overall, to me, this is a neutral earnings report. I can see both sides of it. And so they are raising their ranges here on revenue to go from 61 to about 64 billion. Prior to that was 59.5 to 62.5 billion. And once again, the stock's still trading basically in the same range that it has been. We take a look at where they're projected to do earnings, and this is why I think the stock is selling off. They're projected to do around $2.75 to $2.95, and they're already sitting a little over $2 of earnings. So we can see here that next quarter is probably not going to be a blow the doors off type of quarter. Most of the earnings are pretty much out of the way at this point in time. And so that's a reason why I think we're not seeing a huge spike in the stock. Yes, we're getting guidance upgraded here, but those guidances are because of the offset of Paxlovid from the last quarter, not necessarily what they're going to do next quarter. And so that's why we're kind of seeing, in my opinion, the stock being fairly muted, but there's a lot of things to like about it. They are raising revenue, they are raising margins, they are raising their EPS. We take a look at their pipeline progress, late stage development pipeline progress, July 30th to October 29th. So this is all updated. And we can see here that they have a lot of things being pushed through their pipeline. And once again, what are we seeing a lot of? It's the COVID stuff, and that's not what we want to see. So that's another reason why I think the market's downbeat on them. We take a look at what's in phase 2 and 3 in their pipeline. A lot of cancer opportunities here. So they're definitely going to be a player in oncology, definitely going to be a player in cancer. It looks like they're definitely going to be late to the weight management side of things. But we've kind of seen a disappointment in sales on the weight management side. So, I don't necessarily think that's a bad thing, to be quite honest with you. So we're seeing some pretty solid things popping up in their pipeline from the acquisition of Seagen, it looks like. And we're watching organic growth. Most of the earnings have already come through for the company, and we're seeing that muted reaction because of that. And we're also seeing the muted reaction because more COVID revenues, market doesn't like that. I don't care either way. If you're selling a widget, do you care what widget you're selling as long as it's selling? And so there's going to be fads that happen, whether it's weight loss, whether it's COVID. And so they have exposure to certain fads that are really working well for them. And I don't think you should discount that. We also take a look at what's in their pipeline. Some pretty optimistic things could be coming in the next quarter or two. So overall, I would say it was a good quarter, and that's why I'm neutral on stock. I wouldn't chase either one of these companies. I think, keeping my price targets at 27 and basically under $54 a share for CVS, I would ideally like it in the 40s, is kind of where I have both of these stocks earmarked. So hopefully you guys enjoyed that dive in, and as always, we will see you all in the next one.